Hello, and thank you for taking some time to learn about Bay Street. We are a global investment platform that's focused on unlocking alpha across hospitality-related investments. We do that by taking a quantamental approach, meaning that we are blending data science with real-world hospitality operating insights. A bit about myself, Katie and I have known each other for several years, and we decided to collaborate to build what you see today. I've personally scaled and sold multiple investment-related businesses, with my most recent exit being a wealth management firm that reached 500 million in assets under management. Over to you, Katie.
Thanks, Will. I bring over 18 years of combined experience in multi-asset investments, portfolio construction, deal structuring, and risk management at bulge bracket banks and institutional asset manager, including AQR Capital Management, Bank of America Merrill Lynch, and Deutsche Bank. My passion lies in applying quantitative modeling and strategic insights into identifying high-quality investment opportunities and unlocking values that creates meaningful impact. Which asset class offers yield, inflation protection, global growth, mispricing, and brand value? Yes, hospitality real estate. However, hospitality real estate is the most overlooked real estate asset for growth and income generation. Hotels are uniquely positioned to capture all these 5 aspects, and that's rare in today's market. Hospitality has been historically under-allocated. It represents less than 2% of institutional portfolios, and hotels in particular remain one of the most underappreciated sectors in commercial real estate due to the perceived volatility and operational complexity. However, we believe that this very complexity offers inefficiency that can be capitalized on by specialized investors. There are 5 key factors that make hotel investments not only compelling, but also strategically important in modern portfolio construction, which are the yield advantage through cash-on-cash returns, natural inflation hedge, because hotel room rates can be adjusted in real time and repriced dynamically, and hotels also offer exposure to global growth trend. Additionally, hotels also offer mispricing opportunities due to limited private market information and inconsistent underwriting standards, which can be capitalized on. Hotels also offer brand and repositioning upside, as hotels allow for value creation through branding. We use data, not anecdotes, to quantify each of these factors. We were inspired by our own frustration when evaluating investment deals, so we decided to build a top-down and bottom-up framework derived from our prior success in public markets that could be applied to private hotel-related investments and add much-needed clarity for investors. All that is summarized into a single score called Bay Score.
You're looking at a standardized test score. So think of this like a competitive college entrance exam or a coveted Michelin star rating, except we're measuring hotel investments. So working from the top to the bottom, the score is the sum of the weighted average for metrics that Katie and I care about. If you've heard of Jensen's alpha, our adjusted hospitality alpha is a derivation of that. We're considering how much better is one particular deal versus everything else once you adjust for inflation and illiquidity. The Bay Sharp is derived from the Sharp ratio. So I like to think sanity versus stress. We're trying to determine, how much more return am I going to receive relative to the amount of risk that I'm taking. The more return with the least amount of risk is going to be a winning combo. R is region risk. So for example, we're factoring FX volatility, political stability, and the legal system. F is financial stability, too much debt, unhedged currency exposure, that's going to score poorly. S is sponsor, because the sponsor matters. So they're not just presenting good deals, they're able to exit smoothly. So you're looking at the track record, how much skin they have in the game and exits in the past. M is market structure. So we're looking at the legal opacity and capital repatriation. L is the liquidity. So we are stress testing the exit IRR. L, we are looking at liquidity. We are stress testing the exit IRR. And this all gets rolled up into a single number called the Bay Score. Once you have that, you're able to compare something like a REIT in Singapore to a hotel developer in Portugal to a publicly traded stock, or even a portfolio of the existing hotel assets, all with one unified metric. So now you're going to see that in real life. So you're looking at actual scores on our platform. We ran 3 very different investments through the same framework. The Portugal developer that we're working with scored a 93, so that's top of class, high conviction, high reward. Marriott, public stock that everyone knows about, scores an 87. That's strong, clear institutional play. Host Hotels, a public REIT, came in at 71. It's respectable, but with more muted upside as you'd expect from a REIT. The key point here is all of these formulas from the previous slide are integrated into our platform to determine the quality of a private hotel investment or a public hotel investment, listed or off-market investment, because we're running all those through the same lens. And what that's giving us is a scoring system with institutional credibility. This is very familiar, score of 0 to 100. So you're able to take something that's typically opaque and bring clarity, comparison, and confidence into the equation. So let's talk about what the data is and what's actually happening under the hood. We are normalizing the IRR, the yield, and the volatility across both public and private markets. We're then looking at who's behind the deal. And finally, we're not stopping at the returns. We're measuring over 20 different factors, including things like exit value sensitivity, the brand repositioning potential, and operational leverage. So in short, we're determining what could go right, what could go wrong, and how flexible is the asset going to be along the way. And the final thing that score is providing is it's leveling the playing field regardless of what type of asset or where we're looking. And we're able to identify where the market is off. So when we quantify these mispricings using that adjusted hospitality alpha and the Bay adjusted Sharp, it's going to help us spot where deals have strong fundamentals but are not being priced accordingly. So we're looking to uncover that hidden value that's waiting to be unlocked. And finally, we map each of these deals into real portfolio strategy. So as we test exit feasibility, scenario outcomes, and where it lands on that base score range, investors are not just buying into a good deal, they're able to buy into the right deal for their objectives.
To summarize, we apply a unified institutional framework to hotel investing that consists of the following: an integrated investment platform, a proprietary quantitative valuation methodology based on scoring described in the previous slides, and to capitalize on mispricing and macro tailwind components.
So thank you for listening, and we are looking forward to connecting soon.